Hey everybody, what is up? Welcome back to Funnel Trade. As usual, I have my normal ongoing conversations with patrons, and something that I've seen come up a couple of times recently is this idea that people are jumping into collectibles because they're chasing returns in the market. And I don't doubt that people are doing that. You know, there are always people who have different risk tolerances and are willing to gamble to greater or lesser degrees, and even things like our lovely Swiss government bonds, those are even gambling to a tiny, tiny, tiny degree, even though that would be one of the safest instruments you could buy on planet Earth. But people have different appetites for risk, and some people are looking for outsized returns, whether they have their ducks in a row financially and they just have some extra money and they're willing to risk it a little harder in order to get better return. Or maybe they don't have their ducks in a row and they feel like they need a lottery ticket to catch up to where they think they ought to be. So the way that this argument kind of goes is that people are heading into collectibles for that. And of course, we saw that a lot during 2020 and 2021. We saw, of course, the Rolex market get really, really big, subsequently crash. We saw graded video games get huge and crash. We saw a whole lot of different collectible markets get big, and most of them crash. You know, sports cards pulled back a lot. I don't know if you'd call it a crash. I think if you look at some very, very expensive high-end sports cards, you might call it a crash because some of the, $500,000 to $1 million range sports cards, some of those pulled back several $100,000. Some of them pulled back 50, 60, 70% on their prices from one auction to the next. So maybe we'd say some of those crash. TCGs did pretty good. It had a down period, but now it's coming back very nicely. We're in a healthy bull market right now. But this got me thinking about the idea of chasing returns and how much do you really need to risk to chase returns. And I know one thing that's driven a lot of people in the last several years is high inflation. And of course, I think it was in summer of 2022, we were seeing 9% annualized inflation. And the way that they measure this is every month they try to measure what the inflation was for that month. And then they express it as an annualized number, which means that if you had that monthly level of inflation for 12 consecutive months, your compound inflation would be some number. And that's the number they express. And it's kind of confusing the first time you hear about it. But once you understand what they're saying, you really kind of realize, oh, that's kind of like the smart way to express this number that makes it reasonable. So 9% annualized for some of those months, I believe in the summer of 2022, means that if you took those monthly inflation numbers and you kept them going for a whole year, you would have seen 9% inflation for that whole year. And of course, inflation's come down quite a bit since then. But what most people in America are looking at right now is that over the last 4 years, we've had cumulative inflation of about 25 to 30%. And of course, inflation on certain products is maybe higher, up into the 40s. Inflation on some products is lower. Some products have seen deflation. It's just, that's kind of the normal way of things. But by and large, for most of the things that most people buy, they've seen 25 to 30% inflation. And so that also drives their desire to chase returns. And so this is where I get kind of confused. Something I've said before several times on the channel is that most people, in my opinion, should have most of their money in S&P 500 index ETFs. It's the most boring, well-diversified, mostly safe, moderately safe. I mean, we can disagree on how safe it is. I think it's pretty safe type of investment you can have. And maybe later in life, you would decide to invest in different things. If you're in retirement, certainly you may look at it differently. But for people in most of my audience's age range, 35 to 55, yeah, S&P 500 index ETFs are really what you ought to have most of your money in, just because it gives very good returns. It's spread over the best companies on the US stock market, and it's very well diversified. So I went and I thought, okay, if people are chasing yield, well, how has SPY been doing? And of course, SPY is the SPDR ETF. It's the largest of the index ETFs. Okay, let me move this over here. There we go. Okay, so the S&P 500 ETF Trust, SPY is the ticker. And if we zoom out, of course, we've gone to the 5-year mark on here. Now, remember, most things most Americans buy have seen 25 to 30% cumulative inflation over the last 4 years. Okay. And yet the S&P 500 has risen 90% over the last 5 years. Now, if you say 90%, that's kind of close to doubling. And if we use the accounting's rule of 72 and we do the math in our head, it comes to like 13.1% or something like that. If you take 13.1% for 5 years straight, your compound growth rate total would become 90%. So if you had 13% growth compounding for 5 years straight, you would have 90% total. So that means that we saw in the S&P 500, we saw on average 13% compounding growth rate per year over this 5-year period that we have this chart set to. And obviously you can see it was not smooth 13% per year. It was bumpy, as you should expect a market to be. But my point is, if we've had 30% inflation over the last 5 years, and let's just take our calculator here. I'm not sure if this is going to show up, but if we take 1.3 and we take the 0.25th root of that, so we're taking the 4th root, so we're raising it to the 0.25 power, we get 6.7% is the compounding inflation rate over the last 4 years. So inflation's ticking up at 6.7% for the last 4 years. The S&P 500 is ticking along at 13% for the last 5 years. So why are people feeling the need to chase returns instead of just being in the S&P 500 index ETFs? And there's more besides just SPY. There are ones run by other brokerages and other mutual funds and things that basically all track the same thing. They track the S&P 500. But why are people taking outsized risks? Why do they feel they need to dump a bunch of money into collectibles? Why do they feel they need to change their overall risk profile when if you had just been in S&P 500 index ETFs for the last 5 years, not only would you have had on average 13% return against the average 6.7% inflation, but you also had that for an extra year, because remember, this chart is a 5-year chart that we've done our math off of for the S&P against the last 4 years of inflation, which have cumulatively been around 25 to 30%. So all you had to do was buy this, and you would have been invested in the best companies in the US stock market, and you would have beaten inflation by about 6 percentage points per year. Plus, you would have had a whole extra year where you beat it by probably 8, 10, 12%. I don't know what inflation was in the year 5 years ago, but you would have definitely beat it. And so this is why I wonder about people who feel the need to chase returns, so to speak. And, we all like to play around in this TCG market. We all like to buy Pokemon and buy Magic and buy the other things and put them back in our closet, and once in a while sell a few of them and get those big returns and everything. And it works great, and the returns are typically better than the stock market. But the reality is, most of us should have most of our money in investments like this, things that are pretty safe. And, probably over half of my wealth is in S&P 500 index ETFs. This is the kind of boring bread and butter thing that most people should be investing in. And so I'm just kind of confused. Like, am I missing something here about people wanting to chase returns? This is one of the basic, most dumb kind of investments that most people should be making. And it absolutely clobbers the inflation rate of the last couple of years. So if you're worried about inflation having diminish the relative value of the assets you're invested in, well, the S&P 500 handily beat it. So let me know what your take is on this, because yeah, I understand that some people feel they need to take more risk in order to accelerate their wealth generation. I don't agree with it, and the numbers show that most of the time those extra risks don't pay off. They're risky for a reason, and the reason is your total return suffers as a result of the cumulative amount of risk that you take. But I feel like there's something I must just not be getting here. Let me know what you think, guys. Thanks to everyone who makes this content possible, especially my very generous supporters on Patreon. Like, comment, share, and subscribe, and join me on Final Trade.